Hey! Before you get started, hit that subscribe button. Oh, hit that like button too. Thank you. Woo-wee! You know what that whistle means. It's game time. Let's get it. Look, I want to jump right in. I want to give you a description of a bear market. I want to do it in comparison to a bull market. And I want to put a twist on things and give you a visual learning experience this time, okay? All right. I know we got different types of learning styles, so I want to switch it up, give you something different, entertaining, and interesting on how to make money in a down market. Be sure that you watch this video in its entirety. Then you will start to see all the connections, and then you'll see what President Trump says at the end that ties it all together. Let's get it.
Have you ever wondered what the difference is between a bear market and a bull market? In this video, we'll look at this so you can understand what's happening in the markets today. First, let's look at what a bear and bull market are. The terms bull and bear are frequently used to describe how stock markets are doing, whether they are depreciating or appreciating in value. In simple terms, a bear market is one that is in decline and is considered a true bear market when it has fallen 20% or more from recent highs. In a bear market, share prices are continuously dropping. This results in a downward trend that investors believe will continue. This belief, in turn, perpetuates the downward spiral. During a bear market, the economy slows down and unemployment rises as companies might begin laying off workers. In contrast, a bull market can be classified by a sustained increase in prices within the stock market, which can be noted in the rising prices of company shares. In such times, investors often have faith that the uptrend will continue over the long term. The country's economy is typically strong and employment levels are high. So where do the terms bear and bull market come from? The use of bull and bear come from the way these animals attack. A bear swipes its paws downward while a bull thrusts its horns up into the air. These actions are metaphors for the movement of a market. If the trend is down, it's a bear market. If the trend is up, it's a bull market. Although a bear and bull market are defined by the direction of the stock market, there are many more things to keep in mind. The first is the supply and demand for securities. A security is a tradable and negotiable thing that has some kind of financial value, usually in the form of stocks, bonds, or options. In a bear market, more people are looking to sell their securities than to buy them. The demand is significantly lower than the supply, and, as a result, share prices drop. In a bull market, the opposite is true. There is strong demand and weak supply for securities. In other words, many investors wish to buy securities, but few are willing to sell them. As a result, share prices will rise as investors compete to obtain available equity. Next is investor psychology. Much of how the markets rise and fall is impacted by how individuals and investors perceive and react to the market, also called investor psychology. In other words, stock market performance and investor psychology are very dependent on each other. During a bear market, market sentiment is negative and investors lose confidence as they move their money out of equities and into fixed income securities. Because they keep their money out of the market, this causes prices to decline in the stock market. In a bull market, market sentiment is positive and investors gain confidence. Investors are more likely to put their money into the market, hoping that they will be able to make a profit as prices increase. Lastly is the change in economic activity. Because the businesses whose stocks are trading on the exchanges are participants in the greater economy, the stock market and the economy are strongly linked. A bear market is associated with a weak economy. Most businesses are unable to record huge profits because consumers are not spending nearly enough. This decline in profits directly affects the way the market values stocks. In a bull market, the reverse occurs. The economy is typically stronger and people have more money to spend and are willing to spend it. Businesses will report larger profits and the value of stocks will increase. So what should you do in a bear market? In a bear market, the chance of losing money is greater because stock prices are continually losing value and the end of the bear market is often not in sight. Even if you do decide to invest with the hope of an upturn, you are likely to take a loss before any turnaround occurs. Thus, most of the profitability can be found in short selling or safer investments, such as fixed income securities. An investor may also turn to defensive stocks, whose performance is only minimally impacted by changing trends in the market. Therefore, defensive stocks are more likely to be stable no matter how the market is doing. These are industries such as utilities, which are often owned by the government. They are necessities that people buy regardless of economic conditions. And what should you do in a bull market? In a bull market, the ideal thing for an investor to do is to take advantage of rising prices by buying stocks early in the trend, if possible, and then selling them when they have reached their peak. During the bull market, any losses should be minor and temporary. The ideal thing for an investor to do is to take advantage of rising prices by buying stocks early in the trend, if possible, and the ideal thing for an investor to do is to take advantage of rising prices by buying stocks early in the trend, if possible, and then selling them when they have reached their peak. During the bull market, any losses should be minor and temporary, and an investor can be more active and confident investing in more equity with a higher probability of making a return. Both bear and bull markets will have a large influence on your investments, so it's a good idea to take some time to determine what the market is doing when making an investment decision. Remember that over the long term, the stock market has always posted a positive return.
I hope that helped. If you have any questions, put them down in the comments section and we'll get those answered as soon as possible. Next up, we've got a good one. Gunjan Banerjee. She's a Wall Street Journal reporter, expert at what she's talking about. I love this perspective. I love this angle on the bear market. Pay close attention, ladies. You're really going to like this, okay? All right, here we go. Let's get it.
Take a steep drop, investors can come face to face with a bear market. This is one they encountered in March 2020.
It's been fierce and fast and ferocious, the selling has been, and that's what really has caught everyone off guard.
Bear markets tell you that the stock market has fallen quite a bit, and it's an indicator that major indexes are significantly off their highs. And it's a sign that people are pretty fearful about the market right now.
But just like facing an actual bear, some analysts say the best thing to do when a bear market is approaching is to stay calm and not make any sudden moves. Here's how markets make their way into bear territory, and what has helped turn them around in the past. Stocks enter a bear market when they lose at least 20% of their value from a recent high. Let's look back at the 2020 chart. You can see when the market started to fall in February. It entered a bear market here, just under a month later. The term is a shorthand way for Wall Street to mark when stocks have taken a tumble, a sign that investors are anxious about the future and moving away from risky assets.
There's a number of things that can make investors more risk averse. One, they can grow concerned about how stocks are valued and say, is this stock really worth what I think it's worth, or worth the premium that I'm putting on it? Have valuations run up too far, too fast?
This was a factor in a bear market in 2001, when a bursting market bubble drove down stock values.
I believe I was asked about the markets today. I'm sorry people are losing value in their portfolios.
Another really important factor is the economy. Often bear markets have been affiliated with economic recession. So that's one thing that can really put investors on edge.
Recessions have accompanied 9 of the last 17 bear markets. And while one doesn't necessarily cause the other, problems in the economy can be a major factor in bringing stocks down. High inflation contributed to one of the longest bear markets in history in the 1970s. Other things that can lead to bear markets are big events that threaten corporate profits. For example, that drop in stocks we looked at from 2020 was caused by the beginning of the coronavirus pandemic, when investors were anxious about the effect the virus might have on the economy.
Often investors start to get concerned about the levels of uncertainty out there, and they decide it's time for me to dump stocks. That can drive prices down.
So to review, a bear market occurs when stocks have dropped by a certain amount. But what turns them around? Stock prices depend on a variety of factors that can change quickly or slowly.
There's the Fed, there's the economy, there's U.S. corporations, there's consumer behavior. You have to take into account all of those things.
For the bear market to go back into hibernation, stocks need to rebound by at least 20% from their bottom point, flipping into a bull market. The S&P 500, on average, spends about 142 trading days from the time it enters a bear market to the time it exits. This chart shows 5 recent times the S&P 500 went into a bear market, starting from when the market began to decline to when it made a full recovery. After stocks started falling in 2000 when the dot-com bubble burst, the index didn't hit bottom for over a year and a half, and it took until 2007 to swing back to where it started.
Part of the reason that did take so long to recover was just the sheer magnitude of the boom in stock prices, which made the bust just so dramatic. And it took years for us to reclaim those highs.
But the 2020 bear market turned around in a record amount of time. It hit bottom after just 23 trading days and only took 126 days to swing to a new high. One of the biggest reasons for the rebound was the Federal Reserve and government stimulus. Stimulus checks and lower interest rates helped increase spending, indicating to investors that companies could make it through with government support. Measures like this also helped bring stocks up in other bear markets, like after the market crash in the late 2000s, though the recovery happened over a longer period of time.
When the Fed steps in to provide more stimulus, historically that's helped the stock market.
Other things that economists and analysts say can make investors more confident and bring up stock values are corporate growth and strong employment numbers.
When people feel good about spending money or they're more optimistic about the future, that can drive up stock prices and that can help the economy.
But changing investor sentiment can take a long time, and the recovery can be a difficult waiting game.
For many individual investors, holding tight is often the best path forward. Historically, selling stocks during bear markets has been a terrible idea.
Which is to say, in the past, bear markets have always turned around and have sometimes resulted in high returns for patient investors. But bears are unpredictable, and the next time stocks take a steep dip, it could be years before investments pay off.
Hey, show us some love. We're working hard to provide you with great, interesting, and valuable content. Let's get it. All support is welcome. If you need to, hit the pause button on the video and write down our Cash App information and show us some love. We appreciate it. This helps our team produce more and more helpful content. Thank you. Let's get back at it. Here we go. Next up, this dude's an all-star. Definitely listen to what he has to say. Very important. Let's go.
Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramerica. I'll do my friends. You know I'm just trying to make a little money. My job is not just to entertain, but I'm putting this in context, explaining it. So call me, 1-800-743-CBC. Tweet me at Jim Kramer. The great bear market continues, but you only know that if you're diversified away from tech. For days on end, stocks have been going down and down and down. Just not the great semi-softwares, data center companies with the wind at their backs, riding the tremendous themes of our time, accelerated computing and artificial intelligence. These tech plays are so strong that they end up buoying the averages, including today, which is why the tech light Dow Jones Industrial Average actually dropped 26 points, while the S&P advanced 0.55%. A lot of that, the tech stuff, and the tech-heavy NASDAQ, filled with semis and software, gained 1.24%. And that's what people are looking at, even though you might not know it from the averages. Today was one of the worst days of what I'm starting to call the great selective bear market of 24-25. The bear's been roving around all sorts of areas, mauling the consumer staples, the energy sector, healthcare, the material stocks, all groups that have underperformed dramatically last year and doing it again. Now, understand the hyperbole here. I'm simply pointing out that these sectors, important swaths of the market, aren't anchored to leeward. They spent last year hurting the market, and this year already, many are in the red. It's not just a continuation, people. It's actually an acceleration. Why is it happening? Why is the stock of Procter & Gamble down another 2.7% today? That's a great company. Why is Colgate toothpaste dog food? Why is Colgate down 2.9%? How about Clorox? It got pummeled. It's down 3.3% today alone. All right, so let's go over the reasons. One, maybe the biggest reason, someone would say, are interest rates. When long-term interest rates spike, as they've been doing ever since the Fed started cutting short rates, these stocks have been hammered. That's what happens. The dividends, by the way, are supposed to offer some protection, right? But they become a source of vulnerability when bond yields, the main competition in dividend stocks, keep marching higher. And they might do that all week because the long rates are rising thanks to supply. The Treasury Department sold 3-year notes today, and the auction fell flat on its face. Tomorrow, the Treasury sells 10-year paper. And Wednesday, I don't know if the market is prepped for 30-year paper, but there's a ton coming. As these bonds go down in price and up in yield, things get worse and worse for the dividend stocks, even if there's actually nothing wrong at the companies. Which brings me to the second reason this group has just been hammered. The dollar's gotten too strong. These consumer packaged goods companies tend to be very big overseas. That's not the case with Clorox, which is largely domestic. But you know how our stock market works. The consumer staples all trade together. If the dollar hurts a big international company like Procter & Gamble, as it is, it's going to reverberate even into a Clorox because they're all in the same sector. And sector ETFs are like gravity. They pull all their subjects down, even the ones that shouldn't. Now, then there's the most insidious problem of all, the one that no one is talking about. Let's open the discussion. Pricing. Now, have you noticed that when you buy consumer products on Amazon, they're discounting heavily, particularly the stuff you see at a drugstore? Have you seen the pressure being put on companies by Costco, where it's like a different world with those prices? They're crazy low. I know that Walgreens is trying to keep up, offering their own outrageously lower prices on their website, but you probably don't go to their website. Now, it is true that profitability may be pinched at some of these retailers, Walgreens, Dollar General, Dollar Tree, Target, all of which sell these goods, and they've all seen their stocks just get crushed. Walmart, Costco, and Amazon have more scale and can get you better prices for many daily average needs. But if the retailers are being squeezed, then their suppliers are definitely going to be squeezed too. Maybe these companies have had so much of a run, so much price flexibility post-COVID that they are finally losing it. Maybe the consumers had it, will no longer tolerate COVID-era high prices from the likes of a Procter or a Colgate. Maybe the stocks are saying prices will indeed be rolled back. Sell, sell, sell. Sell, sell, sell. The stock of Procter & Gamble is, it's tempting. It's tempting. But as long as bonds go down in price, as long as the dollar stays high or goes higher, and until we see the earnings find out there really is some price pressure that I'm sensing, it's too risky to buy. Now, I look at this counterintuitive situation. I know it sounds crazy to call Procter & Gamble and Clorox, Colgate risky. These were safety stocks for most of my life, but there's nothing safe about their stocks anymore. This is a market that rewards growth regardless of price. So people will pay up for tech growth, which is all about real demand and pricing power, and they're avoiding companies that have lost pricing power and offer yields that are too low to compete with treasuries. I don't expect that dynamic to change anytime soon. Next bear market, oh my, it's in healthcare, as this group's off 20% from its highs. Next week, I'm going to the J.P. Morgan Healthcare Conference to find out what the heck is going on in this group, and I am aghast. These stocks are just hideous. Humana is down 43% from its highs. HCA, the hospital company, off 29%. That one's been a winner for years. Signal off 25%. Well run. Centene down 23%. A wasteland of burned-out companies. Look at the biotechs. Whoa, Vertex off 23% from its highs. That's a great company. Amgen, Dow stock down 25%. Regeneron, for heaven's sake. Biogen off huge. Moderna down a hideous 75%. Remember when they were strong? That are heinous now. Food Group just taking it on the chin. Hormel, great company, down 17% from its high. Smucker, General Mills, Conagra off 19%. Hershey, Campbell's, Kraft Heinz, and the Mondelez all down in the low 20s. That's incredible. Same script, higher rates, stronger dollar, pricing pressure. But let's throw in the GLP-1 weight loss drugs, too. We know these companies are loath to admit that GLP-1s have anything to do with their weakness. But that Cornell Business School study I referenced last week, it talked about a 6% decline in grocery spend for people who take drugs, the GLP-1 drugs. Processed foods are designed, in part, to be craved. But when you're getting these GLP-1 injections, you crave nothing. Maybe the sales decline is just beginning. Maybe that's what the stocks are saying. What else? Real estate, wasteland. Just today, we saw Federal Realty and Kimco's shopping center and a strip mall company get crushed. Two of the worst stocks in the S&P. Now, this is highly unusual. These companies are linked with interest rates, and the spike in long rates has all hurt them. But the actual businesses, they're terrific. It doesn't matter to the stocks, though. What matters is interest rates. Hey, listen. As bad as those are, because I just said about rates, the bear has really mauled the housing stocks. The declines are staggering. Lennar, trading at 193 in September, it's down 135. Toll's going from 169 to 126. Pulte, 149 to 109. D.R. Horton, 199 to 139. And no time flat. What do you think it says? I think the home prices are going lower, maybe much lower, something that no one is thinking about. But nothing's as bad as the materials, mining, minerals. When you look at the stocks in this group, and I'm talking about plastic, I'm talking about wood, it's almost enough steel. It's almost enough. There's got to be something going on. If you didn't know any better, you think there's a recession. The chemicals, the papers, the coppers, the steels, they are factoring in a definite recession. No other way to explain the decline. How Nucor stock's down 41% for the top, New Mining down 36%, Freeport, the copper company down 30%. Cleveland Cliffs has plunged from $22 to $9. And how about the oils? They're all horrid, too. Which brings me to a thesis that's not talked about much when we see all these Federal Reserve officials telling us how inflation is not being brought to heel. It's true. There is plenty of inflation, particularly at the supermarket. But the bottom line, when you look at these super underperforming stocks, all I can say is maybe the Fed had better be careful for what it wishes for. Companies that represent a gigantic chunk of the real economy have seen their stocks swoon. Could their earnings be that far behind? And could inflation be running its course a lot faster than expected? Considering the stocks that are going down and the magnitude of the declines, I'll tell you, it sure wouldn't surprise me. I'm going to Frank in Texas. Frank.
Hey, Jim, a hearty Philadelphia Eagle booyah to you.
You bet. Let's hope that Hertz is okay, booyah. What's going on?
Well, first of all, a hearty thanks to you for all you've done for my wife and I. You made a major difference in our life. Thank you. Don't ever retire.
Yes. Well, I'll tell you, I think that my wife wants to hear that. She wants to hear people say that because I know that she feels like I'm a little long in the tooth, but I like being here. What's going on?
Well, Jim, I have a position in Netflix at a cost basis of $9.89 or $8.92, and I've been buying on dips, and I'm wondering if I should buy more, hold, or sell.
I'd buy more. I know the chart looks like it's rolling over. Maybe you wait till like 800, but I would buy more. I think that they are still the national water cooler stock. It's very unusual to have something like it. Look, spoiler alert, I just have to say this. My wife stopped watching mid-show the final Squid Games. And I just want to point that out because there are a lot of people who might be a little more sensitive. That's not a spoiler. It's just, I'm just saying she walked away. It's pretty dazzling. We watch everything together. Anyway, companies that represent major parts of the economy have seen their stocks swoon lately. The big question is whether their earnings will follow. On Mad Money tonight, what's behind the decline in some defense stocks? I'm taking a closer look at this cohort and how the incoming White House could affect the space people aren't talking. Then I'm bringing you another bull versus bear analyst duel. This time it's on Uber.
Stay locked in now. Watch how it all ties in at the end. Watch what one of the greatest of all time says, Warren Buffett. Check it out.
Contrary to popular belief, bull markets do not last forever. Now, what we have seen in the past, when markets do reach that 20% decline, what usually follows is a total 30% decline, and it can take up to 2 years on average for markets to actually get back to their original values and start moving higher. Now, that's the bad news. The good news is that bear markets also do come to a close, and there are things that you can do to protect yourselves during a bear market decline, and in fact, even make some money while it's happening. Now, the most important thing, lesson number one, is do not panic. That's the worst thing that you can do is chase a market lower. You're going to lock in losses and you're going to regret it later. What you can do is you can strategically take some risk off the table and raise some cash. Cash, for the first time in a decade, gives you some return. A 3-month treasury note actually has yield now. So does a money market. So does even a plain vanilla savings account. So what's the advantage of raising cash during this time? So you have opportunities later. You can buy things that are on sale during a bear market, make some great investments for value. You want to talk about value? Let's talk about Warren Buffett. Back in 2009, when everybody else was panicking, Buffett made a big investment in the Burlington Northern Santa Fe Railroad.
And I just basically believe this country, will prosper, and you'll have more people moving more goods 10 and 20 and 30 years from now, and the rail should benefit. But it's a bet on the country, basically.
He believed in America back then, and he also believed that the bear market was going to end, and when it did end, there was going to be a bounce back and an opportunity to make money. That bet played out into one of the best bets of Warren Buffett's career. He has made a ton of money on that over the past decade. Buffett's philosophy can be summed up in just looking for value during bad times and trusting that things are going to turn back around again. Remember what Buffett says: be greedy when others are fearful, and fearful when others are greedy. Think safe havens during these times. Short-term bonds, commodities like gold and silver, those are all traditional places where investors will put their money for safety during times of turmoil in the financial markets. If you are going to dabble in stocks, keep a few things in mind. High dividend stocks are an excellent place to put money. Why? Because you're getting paid to hold them. Also, preferred shares along the same lines. And if something does happen with the company, you get paid. In a bear market, people are tightening their belts. So think about where they're going. They're going to discount stores. They're going to Walmart. They're going to Dollar General. Back during the crisis, while the rest of the market was falling apart, Walmart held its value. Why? That's where people were shopping during that downtime, and investors were rewarded for it. Real estate also can be a solid investment during these times. Yes, prices can go down, but they've shown to be less volatile over time. Also, it's nice to know that even if it's not appreciating in value, you can actually live there. Remember, it's not just a U.S. stock market, it's a global stock market. And over the past couple of years, global stocks have gotten beaten up fairly badly. So that's going to present you with an opportunity to find bargains there as well. No one knows how long a bear market can last or how strong it can get, but there are ways for you as an investor to make your way through it.
Remember, this thing is global and there are ways to make your way through it. Okay, keep that in mind. All right, next up, bear market strategies, game plans specifically for you to execute and keep on making money. Here we go.
Let me just talk about bear market strategies. These are some of the points that I wrote down that I thought maybe could help. Number one goal is that you don't want to lose lots of money. You just don't want to give back everything that you gained in the prior bull market. And that's why selling is so important, to preserve the gains. I've always said if you can get out within 10%, maybe even 15% of your high equity mark, you're doing a pretty good job, because sometimes the tops can be very violent and you can lose a lot very, very quickly. But once you recognize, hey, this is not a good market, then you really have to go to a lot of cash. And I just read the other day that since 1928, a bear market occurs every 4 years. So you have to know that sooner or later something's going to start. And then the second point is focus on the price action of your stocks much more than the fundamentals. I mean, the fundamentals are looking back, and the price action is actually lots of times, what you're seeing in the market today is reflecting where the fundamentals are actually going to be 3 to 6 months time period. So if you see stocks starting to break down, you see the market, the index is starting to break down, it's telling you that fundamentals are probably going to change. So don't focus on what's already been reported, but more on the price action. And then third point, and this is that this is what William O'Neill actually, when I was looking at, I was going through and looking at his comments on bear markets, he said the typical bear market usually has 3 separate phases or legs of a decline, interrupted by a couple of rallies that last just long enough to convince investors to begin buying. So, and some of these bear market rallies can actually last 15 weeks. And most don't last that long. And so far in our, since we've seen the top late last year, we had really a 2-week bear market rally, and then things came off again. So, and then also, I wouldn't try to pick the fourth point. I wouldn't try to pick the exact bottom. Don't think you had the goal is to get in at the bottom and say, oh, I bought that bottom day. It is much better to be late and wait for the market to actually build a base, build a bottom, and then start turning and following through. So don't be in a hurry. The goal is not the bottom day. The goal is to wait for the turn to set up. And in many cases, you get retests of lows where, even the buying that was done on Friday and on Monday, that might not be, even in a bear market rally, they could come down and retest and then have a 2-week or a 3-week rally. So just wait, be patient. And most bottoms don't hit a low and then go straight back up. Most have retests. And then the other thing I've always found that's very interesting, and maybe now we can look at this period of 1991. You'll see, and David, maybe you can point this out. We really had the first move down was into August. You went from 396 down to about 338, right there. No, go back. Yeah, that would probably be leg one. And then there you go. There's one. And then the leg two would take it from, it rallied for a couple weeks and then it went down to 306. That would be leg two. And then you rallied. You had another 2 or 3 week rally. You went to 326 down to that 290 area. So that would actually be the third leg down. So those are 3 legs down. And then you rallied back up. You had 2 very, very strong, 3 strong days, 1, 2, 3 back up to 319. And then you actually came back down, retested, even undercut that. And then the whole thing started changing. Now, because the interesting thing, if you look at the move up to previously when it went from about 295 up to 319, look at the volume change. If you could point that out, it's at 2.2. 202. No, go back a little farther. There, right? Yeah. On those 3 days, look at the volume change. You had 3 huge days in a row. Then when you pulled back down and had that last little undercut, the volume did not get as high as those 3 days. That's a real key. Then look at the volume pick up again. The whole picture starts changing on a supply-demand basis. The volume is now changed from huge volume spikes down like you saw in July and August, and now in October and November, you're starting to see a lot more blue volume, a lot bigger volume as you start working your way up.
The next video is a little bit more confirmation that we are at the brink of a bear market, perhaps. Let's check it out. Take some notes, write down any questions, put it in the comments section. Don't forget to hit that notification button so you get all the latest videos. Let's go.
December was crazy. I don't know if it was as crazy for all of you as it was for me, but it wasn't a good month for me. Everything that I was expecting to happen in December kind of flipped upside down. It went against most historical norms, as I'll be able to show you here in just a couple of minutes. But, when we look back to, where the market was and what was leading going into December, and look at those historical trends and so forth, everything kind of got flipped upside down. So it was kind of an interesting, look at the market, because when I do a seasonality report, a monthly seasonality report for our members at Earnings Beats, which I just sent out probably an hour or two ago this morning for the month of January. And I was looking at the results for December, and the S&P 500, I think, was down a couple percent, but the NASDAQ was actually flat. And yet 19 of the 20 seasonal stocks that we provided a month ago, stocks that historically have done very well in December, 19 of them were down. The average return on all 20 stocks was minus 8%, whereas, like I said, the NASDAQ was flat, S&P was down 2%. So it was our worst month of the year in terms of the seasonal. We give top 20 seasonal picks for each month of the year. It was by far the worst month. And when we look historically at what sectors tend to drive the market in December, it was pretty much everything was flipped upside down. We were seeing strength from areas we typically see weakness in December, and we were seeing weakness in December from areas that we normally see strength. Anyhow, we're going to move on from all that. It's 2025. Hopefully, we'll have a much better January that follows along, maybe a little bit more according to plan. But first, let's take a look at what happened here over the last week with our major indices. We did see the S&P 400 mid cap, and I literally just updated this. This is in the middle of the trading day on Thursday. So I did just update this here just as of a couple minutes ago, and we had the mid cap 400 mid cap index down 0.85% over the last week. Russell 2000 down 1.13%. Then we had the transports, the Dow, S&P, and finally the NASDAQ, which closed the year down, or closed the last week of the year down 3.03%. Interesting fact here. I was looking back because, you know, I follow a lot of history, and I've talked a lot about the Santa Claus Rally. For me, it usually runs from the 21st to the 31st. That's when I look at it. That's when all of my research tells me that that is the time when you want to really make sure you're in the market. I know a lot of others follow maybe the period from Christmas to New Year's, but I wanted to just mention that in 2024, we did something. We closed the year doing something that we had only done one time since 1950. It occurred in 1966. And that is that every day, every trading day from Christmas through New Year's was down. Every one of them was down to close out 2024. The only other time that's happened since 1950 was in 1966. And the losses that we saw in the final week were higher than we saw in 1966. So this was the worst Santa Claus rally. There was no rally, by the way, but this was the worst period of that December 25th to January 1st. That was the worst period that we've seen in 75 years in 2024 to close out. So really, I guess, I don't know, maybe it was that final bang that says, hey, December 2024 wasn't like anything else that we were accustomed to.
We've got another expert on deck calling for a bear market in 2025. So we have to pay attention to all these particular reporters, experts, people that do technical analysis. We have to pay attention. As a wise person told me, I'm not trying to scare you. I'm just trying to prepare you. Stay locked in. Again, we're in the fourth quarter. You guys stay focused and disciplined. Here we go.
But if it was game of David Roche, would it be the bear market is coming?
I think it's probably coming, but probably in 2025. We now know what will cause it. Two things. One is that the Fed stops reducing interest rates at a higher rate than the market would like, so at 350 at the very, very lowest rate. And the second thing is that profits don't fulfill expectations because the economy is going to be slowing. And of course, within that economy slowing, you've got the AI sector, which I personally believe had entered bubble terrain decisively and is now, over the next 6 months or so, going to exit bubble terrain. So if you take those three things together, I would say, together with, I mean, I haven't factored in what if Trump wins, what if Harris wins, what does this actually mean? Leave that to the side for the moment. I think there are enough in those three factors to cause a bear market of minus 20% in the 2025, maybe the starting in the end of this year. But that'd be my view. For what it's worth, probably not much.
Not that it's the Fed's job to control or react to the markets. Nonetheless, somehow by default, it kind of does. Is the Fed in a position to be able to prevent a bear market?
Oh, yes. I mean, when this actually happens, what the Fed will do is as usual, I mean, the pain threshold in the United States for Fed officials and consumers and politicians, the pain threshold is about 2.5 inches off the floor. So the minute you get through the pain threshold, they'll save the market by cutting rates. Now, whether that actually turns into turning a bear market decisively, it will stop it becoming something really draconian that would undermine and destroy the world economy. That's not going to happen. But on the other hand, the likelihood is, yes, of course, the Fed has plenty of room to cut rates if things turn out worse than it expected. And it has repeatedly said so.
Hi, David. So is this a case of the market attempting to get its head around whether the economy is just slowing or falling off a cliff. And if so, what are earnings telling us? Are they telling us that we have hit peak margins for this cycle? And is that a leading indicator telling us that we are seeing a material slowdown that we have to price?
Well, look, let me put it to you this way. The Fed can't reduce interest rates unless the economy slows down, which means the labor market has to cool, and it is cooling. If it was not cooling, interest rates would not be reduced, and the market would be most upset. But at the same time, the market has now put another cloud in the sky. They don't like anything which implies lower growth because they're afraid of lower earnings. Well, you can't have it both ways. If you want the Fed to reduce interest rates, then the economy has to slow down, labor markets have to slacken off, and margins will come under pressure. So I would say to you, you're probably going to get a mixture of both. Again, putting politics aside, tariffs and all the nefarious implications of disrupting global trade, putting that aside for the moment, you are nevertheless going to get your interest rate cuts, market rejoice. It won't be 50 basis points, it will be 25 because there's no need for 50. The economy remains too resilient. But you are also going to get lower margins, but the lower margins will happen progressively over 2025.
Hold up 4 fingers. We're in the 4th quarter. It's time to win the game. Listen to what President Trump has to say. Now, if this doesn't ring a bell, what else will? Watch what he says when Cramer asks him what would he tell investors. Real important stuff. Here we go.
I think you're going to see some very good days ahead. A lot of incentives are going to be given. You saw yesterday a $1 billion investment that we give you very fast approvals. Nobody's come up with that one yet, although it seems pretty simple. I think you're going to have some great days ahead. We have to conclude a couple of bad wars that are going on. A lot of bad things are going on, but we'll get them done.
Do you think that we are in a situation where business will be far more embraced under you than currently?
Well, I don't want to really knock current, but I will tell you more than at any time, anywhere in the history of our country.
Now, we used to speak together about the idea that the averages mattered and were a good barometer of your performance. Is that still the case when we go beyond Dow Jones, maybe to NASDAQ?
Well, I think I've always said, to me, stock market is all of it together. It's very important. It's an honor to be here at New York Stock Exchange. I sort of joked that I actually bought the building across the street because the stock exchange was here. It's a big deal.
40, it's a nice building.
40 Wall Street. So, look, we're gonna do things I think that haven't been really done before. We're gonna be cutting taxes still further. You know, we got it down to 21%. We're gonna bring it down even below that. You pay 21 if you don't build here, and meaning your product or whatever it is you're building. And if you do, we're going to try getting it down to 15%. But you have to build your product, make your product in the USA.
And how about every working person who's watching it would love to be able to see dividend tax maybe much lower, capital gains much lower?
Well, we're going to be talking about that, and we're really talking about lowering taxes. Last time, as you know, we took it probably from close to 44, 45%. Down to 21. Everyone said that was impossible. Now, it was always I really wanted to get it down to 15, and we'll be able to do that. And if you remember, we had the best 3 years in the history of our country from the standpoint of the economy. And you've been so professional and so good. I haven't seen you so much since I've been a politician.
Well, thank you, sir. We were together, and I was grateful to be a judge on The Apprentice. We had a great time.
That's right. You were a judge. He was a tough judge. He was a tough judge.
Well, we had to eliminate some people who didn't cut the mustard. You made me a hatchet, man. I respect that.
Yeah, well, we're going to be doing the same thing, I can tell you. This, unfortunately, there's too many of them. But I think we're going to really incentivize the country to go back and work, and they will be incentivized. They're going to do well. People are going to be very happy. JD is very much involved, and I have a great partner right over here with our First Lady. People love our First Lady, and we're going to do something very special. We have some great people up there. You saw some of the people on the cabinet, and we have some of the most successful people in the country, and we're dealing with the most successful people, and those are the people that put others to work. And we're going to be hitting job numbers, and as you probably heard me say, we picked up, since just the election, $3 trillion in, you call it worth or value, but $3 trillion was picked up since November 5th, so that's pretty good.
When President Reagan was here, he talked about putting the bear into hibernation, letting the bull run free.
Yeah.
Sound like a good motto?
Sounds perfect. I can't do any better than that. That's what we're going to do.
All right. Now, I know we've got some other people here, but I don't see Elon Musk. I was hoping because he's been a good, let's say a good aid to you on a lot of different things, whether it be crypto or whether it be GLP-1 drugs. I mean, there's a lot of different ideas.
Well, he's got a lot of ideas. He's a great guy. He's a really good guy, too. And I guess his stock has done pretty well. Everybody's stock has done well since the election and even before. And Scott Bessent's done a fantastic job. And one of the things I liked about Scott is that he said long before I even know who he was that the market's only doing well. This is before the election. It's only doing well because they think Trump is going to win. So we made Scott the Treasury Secretary, which everybody frankly wanted. And he's going to do a fantastic job.
How about a crypto? Really, we do need, I think, you're embracing crypto. Yeah. Very different from the previous administration. Strategic Petroleum Reserve like for crypto?
Yeah, I think so. We're going to do something great with crypto because we don't want China or anybody else, and not just China, but others are embracing it, and we want to be the head. We're going to be ahead of AI. We're going to be way ahead of AI, and we've got to produce tremendous amounts of electricity. You know that. It's unbelievable when you think that we need more than twice what we already have. If you think that's pretty for a specific industry, but we'll be able to do it. We have Lee Zeldin in charge of the environment. He's going to be giving us very strong approvals, I think, and he's going to make sure everything's good and clean and proper, but he's going to give us very fast approvals.
Natural gas makes it so that we should be able to afford it and be able to handle the 5% per year grid. Right. But obviously you think that we need to be able to be the king of AI, which means that we also have to, some people would say, protect Taiwan, because China would like very much to be able to have that technology.
Well, we're going to be having a lot of talks with China. We have a good relationship with China. I have a surprising relationship. Now, when the COVID came in, I sort of cut it off. That was a step too far. That was, as they say, a bridge too far. But we've been talking and discussing with President Xi some things and other world leaders. And I think we're going to do very well all around. And we've been abused as a country. We've been badly abused from an economic standpoint, I think. And even militarily, you know, we put up all the money, they put up nothing, and then they abuse us on the economy. And we just can't let that happen. We're not going to be abused anymore. We put America first, but we're also going to help other countries.
I know you've got a ton of things to do, but what can you say to the working person who owns stocks? Should they buy more stock?
Well, I don't want to get into a situation where they do and we have a dip or something, because that can always happen. You know that better than anybody in the world, probably. I think you're the leading authority in going up and going down, but you always end up. He always ends up. That's the good news. But we have like Doug Burgum standing right over here, has done a fantastic job. He's been on your show many times, and we have just tremendous people. I would say this, I think long term, this is going to be a country like no other. We had the 3 best years ever until COVID came in, and then we did a good job getting rid of it. The stock market, if you look at the markets, were higher than just previous to COVID coming in when we handed it over. And now we know, I know the people, I know the players. When I came in, it was very interesting, Jim. I came in and I was not a Washington guy. I didn't know too many people in Washington. I had to rely. Now I know people. I know people so much, they're coming out of my ears. So we have great people.
Mark Zuckerberg?
Well, Mark Zuckerberg's been over to see me, and I can tell you Elon is another, and Jeff Bezos is coming up next week. And I want to get ideas from them. Look, we want them to do well. We want everybody, and we want great jobs, fantastic salaries. We want people to love, and, you know, when they wake up in the morning, like, get up, and I love to go to work. I want to go to work. We want people working, and we want them working for a lot of money.
All right, Mr. President. Thank you so much. Good to talk to you again. Thank you. Thank you.
Did you catch that? Did you get it? I mean, basically, he told you that there may be a short-term dip, but in the long term, you'll make some money. So look for a dip and then look to make money in the long run. A wise person might call this free game. There you have it. Another one in the books.